Hello and welcome to this video. In this video we're going to talk about how to pay yourself as a business. Hello, my name is Patrick. I'm a chartered accountant, certified UK trainer and also that QuickBooks Chap. Welcome to Boffix Tax Tips, the place on the internet where you can make sure that you've got all the information you need for your small business. Remember our motto at Boffix: we want small businesses not just to survive, but thrive. Okay, in this video, we're going to look at one of the most asked questions we get as an accountancy firm, and that is, how do I pay myself? Now, the question of how you can pay yourself all depends on which type of business you've got. Typically, most small businesses operate under two different groups: sole trader and partnerships, which we're going to count as one, and a limited company. Remember in the previous videos where we talked about the difference? Well, a limited company is when you have a separate legal entity, and a sole trader or partnership is when you're recording your business and put it on your personal tax return. So let's start off with sole trader and partnerships. Now, the reason I'm putting them all in the same bag is because when it comes to paying yourself, you're going to be looking at it in the same way. Now, the first thing to think about is that notion of paying yourself. Some people think that paying yourself means that you've got to actually physically give yourself a pay slip. And in that notion, what you're talking about there is you're putting yourself on PAYE. So you write yourself a pay slip out and pay yourself the net, and you take away tax and national insurance before that. As a sole trader or partnership, that's a big no-no. Think about what you're doing as a sole trader or partnership. What you're doing is you're recording everything you sell. You're recording against how much it costs for you to sell that item, and then you're also going to record against other expenditure as well, like rent and everything else that goes with it. If you look at what you've sold, that's your turnover, less what we call cost of sales, so that's what it takes to get to selling that item. So if you bought that item in the first place and then sold it on, that's classed as your cost of sale. And then you less any other what we call administration expenses, so rent, telephone costs, things like that. Now, the reason we're doing that is because we get to a really important number called your net profit. And that net profit is shown over the year in which you've been trading for. Now, we take that net profit and we put that net profit into your tax return. And that forms the basis of how much tax you're going to pay in a given tax year. Therefore, every time you sell an item, it trickles itself down and appears in your tax return. So you've already been taxed on every penny that sole trader or partnership has already generated. Therefore, you don't need to pay any additional tax over when you pay yourself. The notion of you paying yourself is you taking that profit that you've generated, making sure you've considered for tax, so you're making sure there's enough in there to pay the tax man, and then anything left over, you have two choices. You're either going to reinvest that in the business and help the business grow, or you're going to take the money out and you're going to spend that personally. Either way, it's your choice. And there's no tax consequences for how much you reinvest compared to how much you take out. So if you reinvest every penny that company makes, or you take every penny of that and you spend it on yourself, both ways the tax bill will be exactly the same. What you take out of the business has no bearings as a sole trader or partnership to how much tax you're going to pay. So when it comes to how much do you pay yourself as a sole trader or partnership, however much money you've made. What you've made less that tax money is what you have left over to pay yourself. And you can pay it in any way you want to pay it. Now, as a pro tip, do think about how you're going to look at the future. Think about what your business may need to continue to survive. Remember, as a sole trader, that every time you take out any loans or you take out any credit terms, it's you personally that's going to be liable for that. So what you don't want to do is take all the money out of the business, leave yourself short and not have enough money to pay loans, etc. Because ultimately those loans will be down to you to pay them. And also you want your business to thrive and you want it to grow. So you want to think about how much money do I need to leave in the business to make sure that it's got enough money to tick over and continue to grow and make you money. But ultimately, doesn't matter how much money you take out, you're not going to be taxed differently as in you take the money out or you leave the money in. And whatever happens as a sole trader, do not put yourself on PAYE and do not pay yourself through there. A, it's really inefficient, and B, technically you're not allowed as a sole trader to put yourself on a salary and pay yourself a salary. Okay, so that's you as a sole trader. Well, what about as a limited company? Well, as a limited company, it does get a little bit more complicated, and a limited company is designed to be more complicated. Remember, it's that whole notion that you don't physically own the business, it's a separate legal entity. And the idea there is that legal entity gives you added protection. So, you know, if you had any loans or anything outstanding, your house and your personal assets, and if anything went wrong, aren't at risk. That's the benefit of a limited company. The other benefit of a limited company is it's taxed very, very differently, which basically means you get to dictate what your final tax figure is going to be, depending on how much money you take out of the business. The business itself will pay what's called a corporation tax figure, and that corporation tax figure is really straightforward. The same notion as a sole trader. You take how much money you've earned, so your turnover, less any expenses to get to there, less any administration expenses as well. So when you've taken your turnover, less all of those expenses, you create a profit. And your corporation tax figure at the end of each year is based on what profit the company's taken. Now, when it comes to paying you, then we look at it slightly differently. First of all, it's a separate legal entity. So that corporation tax figure we've just talked about is completely independent of yourself. Therefore, how do you get taxed? Well, you get taxed on how much money you take out of the business. And as a limited company, you have multiple ways to pay yourself. The first and most simplest way is you just put yourself on a PAYE contract and you pay yourself a standard wage. Now, the advantages of that is it's really straightforward. What you do is you say you're going to pay yourself X amount gross, then you take away national insurance and PAYE like you would do any other employee, and you pay yourself the net figure that comes out there. And when it comes to paying yourself, we did a nice video of how to do payroll and everything else, or just get someone like Boffix to do it for £5 per month. Either way, it's really straightforward. You say how much you want to pay gross, we then tell you what your net pay is going to be, you pay yourself that, and then the difference gets paid over to HMRC. The main advantage of paying it that way is that salary, that cost, is a cost to the business. So the business in itself will reduce its corporation tax figure based on how much salary you take out. So if you take out 40 grand, for example, in a particular year, then that £40,000 will show as a tax deductible expense within your corporation tax bill, meaning that you don't have to pay tax on that item, meaning you don't have to pay tax on that salary. But when you look at an overall picture, it's not the most efficient way of paying yourself. The most efficient way of paying yourself is to not just pay yourself with salary, but also pay yourself as what we call dividends as well. Now, as the owner of a limited company, you get a lot more opportunities in the way that you remunerate yourself. So as we just said, you could pay yourself just purely salary. But when you look at the tax implications and how much that's going to cost, it can be very expensive to do that in terms of how much tax needs to be paid. Because you're not just paying PAYE and national insurance, but also you've got to take consideration for pension, and also there's the ERS element. So the ERS is how much the business pays on behalf of paying an employee. And when you add all of those elements together, plus the fact that you as an owner managed business will also have to make sure that the company has enough in terms of corporation tax, means overall that's quite an expensive way in terms of tax to pay yourself. So another option is to pay yourself a really small salary, so you don't have to pay PAYE and national insurance, but you still get the benefit of that salary as a corporation tax, and everything else you need, you're going to pay yourself in terms of what's called dividends. Now, all dividends is that when the company's made profit, that profit then gets to be distributed to its shareholders. And typically, if you're an owner-managed business, then you're the only shareholder. Therefore, when you want to pay dividends out, they will only get paid to you yourself. Now, there's some criteria to this. The company itself has to have made profit for you to be able to make a dividend. So if you're in a loss-making position in that first couple of years, this way may not actually work for you. So you've got to be really careful about that. And the other aspect you've got to think about is what tax and when you pay tax on those dividends. So as a dividend, you have to declare that on a personal tax return. So every dividend you earn in a particular tax year, so remember that's 6th of April to the 5th of April, every dividend you earn goes on a tax return. And then depending on how much dividends you have and how much other income you've got, depends on how much tax to pay on it. It starts at 7.5%, The good news with dividends is your first £2,000 is completely tax-free at this point in time. And also it's 7.5% for the basic rate and 32.5% for higher rate. So it's actually a really effective way of being able to pay yourself. The other point when it comes to dividends is it's all dependent on how much money you take out and also if you're owed anything from the business. So when you set up the business, you may typically have lent the business some money. You may typically have given the business some assets. In both of those scenarios, you're then owed money from the business. Therefore, before you have to declare dividends, you can pay yourself money back. And when we talk about how much money is owed to a director of a business, we class this as what's called a director's loan account. So typically, the way that you would remunerate yourself in a business is you would take from the director's loan account first, and then we would either top that director's loan account up with maybe additional dividends or salary or a mixture of both. And it's this notion of a director's loan account which makes a sole trader in a limited company completely different. As I said, in a sole trader, doesn't matter how much money you take out, doesn't matter how much you reinvest in, your tax bill will remain the same. As a limited company though, the amount of money you physically take out of the business for your own personal use has a bigger effect and will drastically change how much tax is due. The easiest way to think about it from a limited company is because it's that separate legal entity means that when you take money out, then at that point there is a consideration for tax. And depending on how you declare that consideration, either purely salary or mixture of salary and dividends, or utilising a director's loan account, depends on how much tax ultimately you're going to have to pay. So how do you pay yourself as a limited company? Well, the first thing to consider is utilising that director's loan. And what I would recommend is you get to a point where you can comfortably figure out how much money you need on a month-by-month basis. Remember, the more you take out of a business, the more your tax you're going to pay. So try and limit yourself to what is, your notional salary, how much you need to take out of that business to live on a month-by-month basis. And one of the things I would always recommend is trying to limit the amount of transactions you take in and out of a business. In an ideal situation, the best way to approach a limited company is each and every month you transfer a set amount of money from your limited company to your own personal account. Class that as you taking money out of your director's loan account. Then you need to make sure that you can top up that director's loan account with either salary or with dividends or with money you're already owed, and you want to keep an eye on that director's loan account. One thing you don't want to happen is you come to a position where that director's loan account becomes what we would class as overdrawn. Therefore, if it becomes overdrawn and instead of the business owing you, you owe the business, and at that point there could be some really nasty taxes that you'll have to pay in addition to everything else we've talked about. So having an overdrawn director's loan account is really, really adverse. Okay, so this seems really complicated, and it is a complex situation. As a sole trader, it's dead straightforward. Everything you earn has already been taxed on. So therefore, it doesn't matter how much you take in or out of that business, you will then pay the same tax bill. So you can pay yourself, quote unquote, whatever you like. As a limited company though, it's far more complicated. It depends on how much money is in your director's loan account at any given time. And then it also depends on if you're able to raise yourself dividends or what salary you're paying yourself. And there's a whole load of different aspects to it. Our advice at Boffix, keep it straightforward and keep on top of it. Have that real-time information. We've said before, QuickBooks is a great solution for keeping on top of your book. And this is an example of where it becomes really, really useful. On all of our clients, as soon as you log into that front page and you look at that dashboard, we show straight away what your director's loan position is going to be. And that means that you as the owner knows what position you're in. If your director's loan account has £10,000 still in it as owed to you, then you know that you can safely keep taking out £2,000, £3,000 a month, whatever the figure's going to be, and you know there's going to be no adverse tax consequences to go with it. If on the other hand, you're down to the last £100 say, then you know that you've got to do something first before you can take money out of the business, either by paying yourself an additional salary or by declaring some more dividends. Either way, you know there's something you need to do before you can take money out of the business. So in simple terms, sole trader, partnership, you don't have to worry about paying yourself. Whatever you've earned is yours to keep. And you decide how much you're going to put in as reinvestment to the business. But remember, that won't affect your tax bill in any way. So reinvesting all 100% won't reduce the tax bill at all. And then as a limited company, you do need to be keeping on top of your books, keeping up to date in real-time information so you can see how much you're owed from the business, and therefore you can decide how much you need to declare and pay yourself on a month-by-month basis. But keep it simple. Set yourself a monthly target, keep paying yourself that monthly target, and then review that on an annual, biannual. Consistency is the key when it comes to limited company. If you can consistently take out the same amount each and every month, you're going to be able to make sure you can budget against it, and you're going to understand how much taxes that's likely going to cost you when it comes to year end. Because one of the things about limited company is you're going to have to declare what you've taken out on an annual basis, and you're going to have to pay as part of your personal tax return. So you need to budget for it as well. If this has become ever so complicated for you, do remember here at Boffix that we offer bookkeeping solutions designed just for this. We take ourselves that step further, and we make sure that you know how much is in your direct loan account and what the tax consequences is going to be of you taking X amount of money out of a business. If you are doing it yourself though, just keep on top of it. If you're using QuickBooks and you're doing it yourself, make sure that as soon as you log in, it's shown on that front page. That's going to give you the impetus and the equipment that you need to understand how much money is taken out and what to expect from a tax position. Hopefully you found this video useful. If you have, make sure you use that like and subscribe. My name's Aaron Patrick, the QuickBooks Chap. I have my own YouTube channel as well, so if you want to know anything about QuickBooks, do jump over to that channel. But also remember to keep your eye on this channel as well. Use that subscribe and like button to make sure you're notified of any other changes that we have and any information we want to give you as part of Boffix Tax Tips. Remember, Boffix Tax Tips is here to make sure that small businesses don't just survive, but they thrive. It's been a pleasure to do this video for you, and I will see you in the next video. Bye for now.
I told him I can be a fighter if you want. I'll be there to catch you if you fall. I can make it brighter when it's dark, when it's dark. I told him I would do it all for you, and I know you do it for me too. I can be a fighter if you want, if you want. I can be a fighter, I can be a fighter if you want. I can be a fighter if you want. All the way that I feel, yeah, I know that it's real, 'cause I can get him out of my head. I don't care what we do, everything's feeling new. Even if we stay in bed, my heart is saying yeah, 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 yeah. You know I want him, nah, 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 nah. My heart is saying yeah, 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 yeah,